Hello and welcome everyone. Today we are going to discuss about some important concept related to cost. Cost is a very important topic which is a part of chapter 3 in CA Foundation Business Economics. Myself Shandar Ahmed uh, on this special edition of class on Unacademy platform. But before we start, an important announcement for the students who have not yet joined Unacademy. Now you can watch special classes absolutely free, whether it on Unacademy platform or on YouTube. All you got to do is subscribe, download and subscribe to the Unacademy app. All right. So what are the benefits of joining Unacademy? We are going to talk about that. If you are a member of subscriber of Unacademy, you can ask unlimited doubts. You can ask doubt any point in time during the class. You can get high quality solutions. If the batch is in English, you'll get English solution. If the batch is in Hindi, you'll get Hindi solution. You'll receive exam matches for questions. I mean questions which are which are a part of the curriculum, and there is more probability of these questions being asked. You can obtain instant and accurate solutions to the questions and get assistance with your homework as well. Now as far as plus subscription is concerned, for CA Foundation, if you take a 24 months course, you have to pay 24,000 rupees. That will boil down to around 1,000 rupees per month. For 12 months course, it will be 18,000 rupees, and that will come down to 1,500 per month. And for 6 months, it will be 12,000 rupees. That will come down to 2,000 rupees per month. Depending on your convenience, you can choose any plan. And if you want to join or take a combo subscription of CA Foundation plus Intermediate, then for 24 months you will have to pay 32,000 with a discount of 36%, and if you take for 12 months you will have to pay 25,000 rupees in total. On top of this, all the plans, whatever the quoted price is there, if you use the code Yeshas Live, then you will get additional 10% discount instantly. All right, so do not forget to use the code Yeshas Live. Now as far as Iconic subscription goes, if you want to join Iconic subscription, there are a lot of advantages in Iconic subscription, like one-to-one doubt solving sessions are there. There will be structured mock test papers at every level, and every question paper will be it will be analyzed on the platform, and one-to-one feedback will be given. There is a Discord channel. Different various experts from the field of CA, they will come on the platform and give you an insight about how to prepare, what are the changes that's taking place in the industry right now. So for CA Foundation, if you choose Iconic program, for 24 months course you have to pay 58,000, for 12 months 35,000, and for 6 months 25,000. And if you choose CA plus Foundation plus Intermediate combo for Iconic, it is 66,000 for 24 months, and for 12 months it is 49,500. Here also the code Yeshas Live is applicable. Now there is also a CA Foundation Mega Combat Quiz that is going to happen tomorrow, that is 23rd of January at 12 p.m. Now enrollment is free. When you enroll, do not forget to use the code Yeshas Live. So there is a 1 crore corpus of scholarship to be given to various students. The top 100 rankers will get up to 100% scholarship on Unacademy platform. It will help you check your preparation level among your peers, and the questions will be curated by the top educators on the Unacademy platform. All right, and not only that, 100 lucky participants will also win exciting gifts, vouchers, and electronic gadgets like Apple iPad, JBL speakers, and also Amazon vouchers. So please download the app and enroll for free. For combat, enrollment is absolutely free. Now let's continue with the concept of cost. All right, now you see, theory of cost. Theory of cost. You see, cost, when we cover the concept of cost from the perspective of any other subject like accountancy or cost accountancy or financial management or anything, we only generally take into consideration the cost that we have incurred, that is paid to an outsider that is an accounting cost or an explicit cost. But when you are actually performing a cost and benefit analysis, then you have to take also into consideration the implicit cost or non-accounting cost. Now implicit cost as such is not actually incurred from out of the pocket to by the owner. It is not actually paid to an outsider. In fact, no cash payment is made. Then you will be wondering, sir, if I have not incurred any cost, if I have not paid anything, then how can it be a cost? Yes, it is a cost. It's a cost of foregone opportunity. This is also known as implicit cost, opportunity cost, alternative cost, non-cash cost or non-accounting cost. So, in the subject of economics, in order to perform a true cost and benefit analysis, we have to take both explicit and implicit cost. So, cost can be divided into two segments. One is known as accounting cost, which is also very popularly known as explicit cost, and on the other part it is known as non-accounting cost, which is also popularly known as implicit cost, or you can call it as opportunity cost, you can call it as alternative cost, or you can also call it as non-cash cost, by any name you call it. All right. Now, what is an accounting cost and what is a non-accounting cost? You see, accounting cost are those costs which are paid to any third party or an outsider. Accounting cost or explicit cost, we say it is paid to a third party or you can say an outsider, or you can say non-owner of the business, and it can be recorded in the books of accounts. It can be explicitly mentioned in the books of accounts. That's why it is known as explicit cost. What we say that it can be recorded in the books of accounts. All the costs that you have heard about, that you have recorded in the, that you have studied in the subject of accountancy, all the costs, those are all explicit costs. For example, rent on a building that is paid. Now when I am paying rent, I am paying for the premises that I am occupying to the owner of that property. Alright, and when you pay the rent, you record it in your PL account, rent paid. Likewise, when you have borrowed money from a bank, that is, it will create a debt upon you and you got to pay the interest either on a monthly basis, quarterly basis or annual basis. You have to pay the interest. So I can say interest paid is also an explicit cost. It can be recorded in your books of account on debit side of the PL account. You pay wages and salary. They can also be recorded in the trading account and the profit and loss account respectively. You pay for material cost, direct material. In fact, the list will go on and on and on. All the costs that you can find in your financial statement that is paid to an outsider for the goods purchased or the services rendered by them or goods purchased from them, they are all explicit cost. It can be recorded in the books of account. That is, it can be explicitly mentioned in the books of account. That's why they are known as explicit cost or accounting cost. Next, Then what is implicit cost? What is implicit cost? What is implicit cost? You see, implicit cost, we say it is the cost of foregone opportunity. Cost of foregone opportunity. It is not paid to anybody, not paid to anyone, not paid to anyone. So it cannot be recorded in the books of accounts. It cannot be recorded in the books of accounts. Now it creates a confusion. Sir, what kind of cost I'm not incurring but it is still a cost? What kind of cost I'm not paying to outsider or a third party is still a cost? What kind of cost are you talking about? Now let's say there is an opportunity cost in everything that we do. Let's say you are working in some firm, you are employed in some firm, and the firm will give you, let's say it's giving you 30 lakh rupees per annum as a compensation salary, you are receiving 30 lakh rupees per annum. One day you decided that I will not work, I will start my own business, I'll start my own firm, I want to be my own boss. So you quit your job and you used all your savings to start a business. And let's say you incur a total cost of 1 crore rupees. Total cost you incur 1 crore rupees. Let's take this example. Total cost you incur, total cost, let's say you incur is rupees 1 crore. Alright. And the total revenue, that is total income that you generate is say 1.5 crore rupees. So what is your profit? You can say your profit is rupees 50 lakh. 0.5 crore is your profit. Now when you go to an accountant and you show him the books of account, and he will count all the cost incurred and count all the income received, and he will deduct one from the other and he will say, sir, your profit is 50 lakh rupees. But when you go to an economist and say, sir, what is my profit? An economist will say that your actual profit is only 20 lakh rupees. Then you will say, sir, 20 lakh rupees? How you are saying 20 lakh rupees? Because my books of account, these are my books of account. These are the expenditure side or the debit side, and these are the income side or the receipt side. And here I have generated a total revenue of 1.5 crore and total cost incurred is 1 crore. So 50 lakh is my profit. No, you are wrong. You are wrong. The profit is not 20 lakh rupees. The profit is 30 lakh. The profit is 50 lakh rupees. I'll say no. Still the profit is only 20 lakh rupees. Then say, sir, explain how. You say, tell me how much you are earning before you had started your business. You say, sir, I was getting a salary of 30 lakh rupees in a year. How much of profit are you making today? Sir, I am making a profit of 50 lakh rupees. How much additional profit have you made after you sacrificed your income of 30 lakh rupees? Then you will say, sir, I have sacrificed 30 lakh rupees and now I am earning an income of 50 lakh rupees. So it means 20 lakh rupees I am making additionally. That's the catch. That's your profit. Then you will realize the sir is correct. Because I am foregoing the opportunity of making 30 lakh rupees when I am quitting my job. And when I am starting my own business, I am earning 50 lakh rupees. So I am foregoing the opportunity of earning 30 lakh rupees and I am earning a profit of or making a profit of 50 lakh rupees. So actually my profit is not 50 lakh rupees. I have to deduct the opportunity that is foregone. So my profit is, it comes down to 20 lakh rupees. So that is your implicit cost. implicit cost. Not only that, there are different types of implicit cost. There can be n number of different types of implicit costs. Say for example, you have your own building that you had given for rent, and every month you receive a rent of 1 lakh rupees, and one day you decided that I will use this building for my own business. So you evict the person who was occupying the building, and now you are using it for your own business. Are you not foregoing the rental income of 1 lakh rupees? Yes. So it means if your business gives you a profit of, let's say, 1.5 lakh rupees, you have foregone 1 lakh rupees of income, and using this property you are generating an income of 1.5 lakh rupees. So are you actually making 1.5 lakh rupees, or you are only making a profit of 50,000 rupees? You are making a profit of 50,000 rupees. Let's take another example. Let's say you have 1 crore rupees in your bank account. You have 1 crore rupees in your bank account, and the bank is paying you an interest of, let's say, 6% per annum. Alright, 6% per annum. So every year you receive an income, interest income. Interest income is rupees 6 lakh. 6% of 1 crore, 6 lakh. One fine day you decided I will start my business. You withdraw this capital and you use it in your own business. After using it in your own business, you generate a profit of 6 lakh rupees. Let's say your cost that you withdraw the money you are using is at a cost, capital and current cost, so 1 crore rupees, and you receive your income or revenue is 1.06 crore, that is 1 crore 6 lakh. So your profit is rupees 6 lakh. Correct? An economist will tell you that your profit, your actual profit is zero. Why? Dear, you have withdrawn your money from the bank, taken a risk to start a business, and you are earning a profit of 6 lakh rupees. The bank was giving you 6 lakh rupees without any risk. Without any risk. So when your rate of return on a business is 6 lakh rupees, why you are doing the business? Why you are taking the risk? You should leave your money in the bank. Without any risk, you sit at home and watch Netflix, and the bank will give you 6 lakh rupees just like that. So is your profit 6 lakh? No, your profit is zero. How much of extra you are earning when you have withdrawn your capital from the bank? Because the bank was anyways giving you 6 lakh rupees. You will understand the fact that yes, basically I am earning nothing. I have withdrawn the money and I have lost interest income. So that is my opportunity foregone. That 6 lakh I am foregoing. So it becomes my opportunity cost or implicit cost. Any opportunity that is foregone becomes your implicit cost. You cannot show it in your books of account, but it is a cost that you have to take into consideration when you perform a cost and benefit analysis for any business. Clear? That's what implicit cost is all about. Alright? Clear? So when we have to calculate the economic cost, economic profit and economic loss, economic cost includes both explicit cost and implicit cost. So if I have to say what is economic cost, what is economic cost? Economic cost is the summation between or summation of accounting cost plus non-accounting cost. We call it as explicit cost, plus implicit cost. That is your economic cost. So in order to perform a true cost and benefit analysis, you have to take in consideration both the explicit and the implicit cost. Now there are different types of questions are asked from here from different situations. So majorly there are 4 different situations from where the question have been asked in the past. So we'll cover those first, figure out what you understand from here. Let's say I'll keep the figures simple so that you can understand where we are going. So let's say your total revenue is rupees 1 lakh. Total revenue is 1 lakh. If I deduct from this total revenue accounting cost, let's say accounting cost is rupees 60,000. Alright, then you are left with what is known as accounting profit. Accounting profit will be equals to rupees 40,000. From this, if I deduct implicit cost or non-accounting cost, let's say your implicit cost is 30,000, then what you get is your economic profit of how much? Of rupees 10,000. So what you have to know is that if there is implicit cost, understand, if there is implicit cost, then your accounting profit will be more than your economic profit. So what we can conclude here is that if there is implicit cost, then accounting profit will be more than economic profit. So what kind of question they can ask you? They will say, for example, there is implicit cost present or opportunity cost is present. Which of the following is a correct statement? Accounting profit is less than economic profit, wrong. Accounting profit is equals to economic profit, again wrong. Accounting profit is more than economic profit, correct. Or none of the above or all of the above. So option C is only correct. Alright, or they can say that there is accounting profit, there is economic profit earned by the firm. Which of the following is correct? Implicit cost is less than accounting profit, that is correct, because if implicit cost is more than accounting profit, you will incur losses. So this is the first kind of question they can, this is one of the questions, probable question that they can ask in the examination. They have asked in the examination, in fact. Next, they can also say, let's say for example, another situation we'll take. There are 4 situations that you have to keep in mind. So let's say again, total revenue, TR I'm writing, is equals to rupees 1 lakh, less accounting cost, which is rupees 60,000. So you have accounting profit of rupees 40,000. If suppose your implicit cost is rupees 50,000, then you have an economic loss of rupees 10,000. Alright, so you have economic loss. So what we can conclude is that, you see, if your implicit cost is more than your accounting profit, then you don't have accounting economic profit, then you have economic loss. So what we can say is that when implicit cost is more than accounting profit, then there will be economic losses. So this can also be framed into a question, and it has been. All right. Next, third situation. If suppose again total revenue is rupees 1 lakh less accounting cost. I'm taking the same figure so that you can relate to all the examples. So 40,000 is your accounting cost less implicit cost of say is rupees 40,000 only. So your economic profit is 0. So 0 economic profit doesn't mean there is no accounting profit. Sometimes 0 economic profit is also considered as normal accounting profit. So what we can conclude here is that if implicit cost is equal to accounting profit, then you have 0 economic profit. We don't call it by convention 0 economic loss, we call it as 0 economic profit. So when implicit cost is equal to accounting profit, then we get 0 economic profit. So by convention you also must know that 0 economic profit is also known as normal accounting profit. 0 economic profit is also known as normal accounting profit. Then let's go on to the last situation, that is, if again suppose if I take into consideration this total revenue is rupees 1 lakh less accounting cost. So accounting cost is rupees 60,000. So you have 40,000 is your accounting profit. If you have implicit cost which is 0, there is no implicit cost. Implicit cost is 0, then you have economic profit of 40,000 which is same as accounting profit. Alright, you have economic profit of 40,000. So we can say now this situation will never come because there will be some amount of opportunity cost always. There will be some amount of opportunity cost always. So we can say that when there is no implicit cost, then economic profit will be equal to accounting profit. Alright, correct? So now we are going to study about other costs. Now all the costs we are going to study are all a part of explicit cost, and these costs are very important to be considered in order to determine not only the profit and losses but the break even, the point of equilibrium and other things in the determination of cost function. Alright, so different types of cost we are going to study now. So first is your total fixed cost. First of all, we go into fixed. What is a fixed cost, by the way? Fixed cost, sometimes we call it as also overhead cost. Fixed cost or overhead cost. Now what is a fixed cost? What is an overhead cost? Now see here, there are certain costs which have to be incurred by the organization, whether it is producing or it is not producing. It means it has started its business, but right now the production may be not happening. Still you have to incur that cost, and this cost will not change in the short run. Whether the production increases or decreases, the same amount of fixed cost the business will incur. So what are these costs? Rent. Do you think you pay rent according to the number of units you produce? No. If you have taken a premises on rent, whether you produce 1 unit or 100 unit or 1 million unit, you have to pay the same amount of rent. Even if you produce 0 unit, you cannot say to the person who has given you the premises on rent to you that, see, I am not producing, I will not pay the rent. You are occupying the property, you have to pay the rent. Whether you live or die, that doesn't matter. You have taken a loan from a bank. The bank has given me the loan, business loan at 12% rate of interest. Now tell me, can I say to the bank, my business is not doing well, I'll pay a lower interest rate? The bank is not going to listen. I have to pay the same amount of interest, same rate of interest, whether I am producing more units or less units or no unit. So it means this cost have to be incurred by the firm, whether it is producing X unit, Y unit or Z unit, even if it's 0 unit it's producing. That's why we call it as fixed cost. It remains fixed throughout the production process, and it neither increases nor decreases with the level of output. So when I say total fixed cost, it means is the aggregate of all the fixed costs that is incurred by the firm. A businessman is not going to incur only one type of fixed cost. He will have to incur many types of fixed cost. He will have to pay the rent on the building, he will have to pay insurance premium, he will have to pay the interest on the loan that it has taken, and he will have to pay the property tax to the government. So all the cost that remain fixed over a certain period of time, when you combine all that cost, that is known as total fixed cost, aggregate fixed we call it. Alright. So when I have to make a table to determine the total fixed cost, you see here, first of all, how do we say fixed cost? Let's define fixed cost. That fixed cost is also known as overhead cost. It is so called, means why it is called fixed cost? So called because it remains fixed throughout the business activity. In other words, it will neither increase nor decrease due to changes in the level of output. Even when production or output is zero, even when production or output is zero, same amount of fixed cost will be incurred by the business. So when I have to define the total fixed cost through a schedule, let's say this is your output, which is in terms of quantity, and this is your total fixed cost, the aggregate of all the fixed costs that you incur. So let's say 0 output, 1 unit, you can take 1 million, 2 million, 3 million, simple figure I am taking, 2 units, 3 units, 4 units, 5 units, 6 units, 7 units or 8 units. If suppose your total fixed cost here is rupees 1000 at 0 level of output, every level of output you will have same amount of fixed costs that a business will have to incur. Same amount of fixed cost the business will have to incur. Some lag happening or what? Alright. So whether the output is 0, it is 1 unit, it is 2 unit, it is 3 unit, 4 unit or whatever, the same amount of total fixed cost will have to be incurred by the business, same amount of fixed cost. So if I have to draw a total fixed cost curve, don't you think it will look like this? If this is the cost and this is the output in terms of quantity, so this is your total fixed cost curve, TFC curve. It is a flat line, meaning what you see, whether your output is 0 or it is 1 unit or it is 2 unit or it is 3 unit or it is 4 unit or it is 5 unit or it is 6 unit, 7 unit, whatever, you have to incur the same amount of fixed cost, that is 1000, 1000, 1000 here, 1000, 2 units, 3 units, 4 units. It means you will not get any other point. It will be remaining fixed along the y-axis. Now the TFC curve, we say it's a flat line. It is a horizontal line which is parallel to the quantity axis or y-axis, because fixed costs remain constant throughout the production function. The fixed cost curve do not start from the origin y, because fixed costs cannot be 0 even when output is 0. So that's why fixed cost curve have to start from a point along the cost axis or y axis. So what are the things that you need to remember here is that first, TFC curve is a horizontal straight line. Next, it is parallel to the x axis. Third, it starts from a certain point from the y axis. Then TFC curve do not initiate from the origin. It means not from here, alright. It doesn't initiate from the origin, because even when output is 0, total fixed cost cannot be 0. So that is the property of TFC curve. As you can see here, 0 units, 1000, 1 unit, 1000, 2 units, 1000, 3 units, 1000, and so on and so forth. So TFC curve is a flat line. It will be parallel to the x-axis. While it touches the y-axis, it will be a horizontal straight line, and it will not start from the origin. Now, total variable cost. Total variable cost. First of all, what is variable cost? The name itself suggests variable costs are those which vary or change due with the change in the level of output. There is a direct or positive relationship between the level of output and the variable cost, meaning when the output increases, that is, you are producing more number of units, you have to incur more variable cost, and when the output decreases, then you will have to incur less variable cost. If output is 0, then variable cost will also be 0. Then variable cost will also be 0. So what are these costs? Materials, material cost, direct material, labor, that is wages if you pay, salary is fixed but labor is variable. Alright, these are our variable cost. Electricity that you consume, if the machine is running, then it will consume more electricity, because if it machine is running for longer duration, it means you are producing more number of units, so it will consume more electricity. Now remember, electricity has fixed charges as well, but I'm talking about the variable part. Alright, so when I combine all the variable cost, what I'll get is the total variable cost. Alright, so variable cost changes, or we can say varies, with the level of output or production. There is a direct or positive relation between output and the variable cost. That is, more the quantity of output produced, more will be the variable cost, and vice versa. Now remember, when output is 0, variable cost will also be 0, because when I'm not producing anything, why will I buy material? Why will I keep labor and pay them wages? So when output is 0, then the total variable cost will also be 0. But remember one thing here, there is a catch, and that is, though the variable cost has a direct relationship with the level of output, but initially when the output increases, the total variable costs do not increase in the same proportion. Because initially, as you increase the level of output, it will lead to better utilization of resources. Fixed resources will be properly utilized, and when you are properly utilizing the fixed resources, then automatically the variable resources will also be better utilized. So the total variable cost initially will increase at a diminishing rate, but after a certain level of output, it will start to increase sharply. Alright, so what we know about the property of variable cost is that initially the variable cost will increase at a diminishing rate. It will increase, but at a diminishing rate. What I mean when I said diminishing rate, you'll get to know when I put the figures in the schedule. Initially it increases at a diminishing rate, but after reaching, now first of all, why it increases at a diminishing rate? Because, or due to better or optimal utilization of resources. But after reaching a certain level of output, the total variable cost will rise sharply. That is, it will increase at an increasing rate. So, if I go back here and if I start putting the value of total variable cost, if I write it here, total variable cost, you see when output is 0, total variable cost will also be 0. Let's say 1 unit if I produce, I am incurring rupees 200 as the total variable cost. So 2 units when I produce, mathematically I should be incurring 400, but here due to law of variable proportion or better utilization of resources, you may incur only 300 rupees. It means from 0 to 200 the increase was 200, 0 to 1 unit the increase was 200. Now from 1 to 2 the increase it by 100, you see. Then it may increase to, let's say, 360. Then it may increase to 400. Alright. Then it may start to increase very sharply, let's say 600. Then it may increase to 1000. Then it may increase to, let's say, 1400, or let's say 1800. And then it may increase to, let's say, 3000. So you see here how much from here to here it has increased by 200, but from here to here it has simply increased by 100. From second to third unit it has increased by only 60 rupees. From third to fourth unit it has increased by only 40 rupees. So don't you think total variable cost is increasing but at a diminishing rate? But from this point onwards, you see it has started to increase at an increasing rate, 200. From here to here it is increasing by 400. Here to here it is increasing by 800. And here to here it is increasing by 1200. It means start to increase at an increasing rate. So if I have to plot the total variable cost, first of all remember it starts from 0. So if I have to plot a total variable cost, how would it look like? How would it look like? You see here we'll write variable cost and here is the output. It will increase like this. So this will be your TVC curve. It will not increase like this, because if it increases like this it means there is a proportion by which it is increasing. So you see initially when you're producing 1 unit it is increasing by 200, then you're producing 2 units, it is increasing by a lesser margin, then you're producing 3 units, it is increasing by even a lesser margin, then you're producing 4 units, it is again increasing to 400, and then from this point onwards you see if you're producing 5 units it is increasing sharply to 600 and so on so forth. So it will rise very sharply, it will be looking like an inverted S shape. The TVC curve will look like an inverted S-shaped curve. Inverted S-shaped curve. Alright. So let's quickly recap what we have studied about the cost here. First of all, you see explicit cost and implicit cost we have studied, and I've said that explicit cost, when you're talking about cost or economic cost, it consists of two types of cost: accounting cost and non-accounting cost. Accounting cost is also known as explicit cost, whereas non-accounting cost can be known as implicit cost or alternative cost, opportunity cost, or non-cash cost. You see, explicit cost is paid to a third party or an outsider or a non-owner. Alright, it can be recorded in the books of account. Example, rent, interest paid, wages, salary. Whereas implicit cost is the cost of foregone opportunity, not paid to anyone